TheoTrade. This is Don Kaufman. It is October 13th, 2018, and you are watching the TheoTrade Weekend Update. All right, where do you want me to begin? This past week, Mr. Toad's wild ride inside of the broader markets, but we're not going to spend time on this video really assessing some of the positions we had on. Look, we were positioned very effectively for it, not just with bearish positions, but we were specifically looking for these wild kind of what we term 3 sigma moves, and we got it. We were able to close some positions, extraordinary profits on a handful of those risk twist spreads. Now, let's get down to it. I want to make 6 really valid points for trade moving forward. Again, enough of the discussion of last week, right? We know that volatility exploded. Like newsflash, that's behind us. We got to think moving forward. Everything right now, is moving forward. This is now what we're going to term a trader's market. All right, let's get to these points. Number 1, risk in check. If you don't know what that means, well, I'm going to explain it here for a moment. Whatever you position-wise may have on currently, you better be intimately comfortable with it. Now, I cannot stress this enough. When I say like intimately comfortable with your positions, you got to know what your risk is, because if you can't function with the risk that you have on, how are you going to go after opportunity that is sure to surface in the future? Maybe in days to come, maybe in weeks to come, maybe months to come. That's one thing I see all the time. People they have these, large positions on, they can't control it. All their energy and all their time is spent kind of treading water just to keep their head above water in the midst of volatility. You got to get your risk in check. We're doing everything we possibly can here at TheoTrade to help you do that. All right, number 2. Number 2 is a big one. There is no predictability in the midst of volatility. And I just want to throw that out there. I don't care, you got Fibonacci's, you got your Bollinger Bands, you got your MACDs, you got your Elliott Wave, put it all aside. All we're going to do right now is we're going to ping from major levels. In a few minutes, we'll hop on to a couple of charts, and I'll actually show you what those levels happen to be. Now, when I'm talking about levels and pinging back and forth between levels, every day you're going to wake up, you're going to look at markets, you'll be like, oh, the S&Ps are up 20. Oh, they're down 40. Some of your worst fears are going to be achieved, but we're going to ping to very, very specific levels. Again, I will get to those levels, but on a day-to-day basis, you got to wake up with the understanding that the S&Ps are going to fly around by 20, 30, even 50 points per trading session, and a lot of that is actually going to happen in the overnight session. All right, number 3. Expect some wild trading days. Yeah, like you haven't figured that one out yet. But one of the things with expecting wild trading days is, listen, I spent 15 years in the brokerage industry, and you learn a lot in the brokerage industry because you're watching order flow on days like we just saw this past week. And one of the things you learn, contingency orders and stops are going to be the end of you. If you haven't figured that out this past week, you'll figure it out moving forward. Be careful. All right, if you've got any type of contingency order, that means when this happens, and there's a bracket order, and when the moon hits a certain phase, you got to get rid of all of it. Toss it out the window. And again, I'm being very blanket statement because I'm going to tell you right now, you got stops and contingency orders, right? You're going to get hammered in this marketplace. So expect some wild moves. You better figure out, how to mitigate your risk, control that risk without necessarily those stops and contingency orders, because we don't know. One of these days we may open, into even more wild conditions. That is, what happens if we're at 5%, which is limit down overnight. We open with a fast, drop. All of those stops and so forth, they're going to rip people apart. Mark my words on that one, people. Watch the contingency orders and stops. You're going to regret it if you do it. All right. Moving on, number 4 over here. The VIX spiked. But okay, we don't even have to talk about levels. Don't get ahead of yourself. Don't get ahead of yourself. When I say the VIX spiked, okay, well, we're in the mid-20s. All right, listen, the VIX is a very different instrument than it was 20 years ago. I started trading in the late 90s, the VIX at 30, the VIX at 35. You're like, yeah, the thing was rocking. We hit the mid-20s, right? Nobody even felt the fear yet. So again, a little perspective on the VIX. So put it aside for a moment. So what? It spiked, right? You're starting to see a little volatility. As I said, you're entering into what is a trader's market. Moving along, perspective. Let's talk about perspective for just a moment with that, all right? So on this fifth kind of bullet over here, when I say give you some perspective, you have just been through, what, 9, almost 10 years of a bullish marketplace. You hit a little bout of volatility, you're looking at the Russell, you're like, oh my gosh, it could be an opportunity. Perspective. Do me a favor, okay? And I'll show you this in just a moment. Just pull up a 5-year chart. Just do it. 5-year chart on Boeing. The symbol is BA. All right, I don't even have to show you on the chart. Pull it up yourself. 5-year, I don't care if it's a weekly, I don't care if it's a daily. Pull up a 5-year chart on Boeing, okay? That'll give you some perspective on this marketplace. If you don't know what I'm talking about, you're going to see Boeing, well, the rise to greatness. Come on, it hasn't even scratched the surface of sell-side activity yet. And that's the kind of perspective that you need in this marketplace. That is not me giving you an opinion that this is going to be a bearish market, okay? Which brings me, though, to my final point over here. This is return of the trader. Moving forward, okay? You can't be a monkey throwing darts to try to make money in this business. Right? You're going to have to trade. You're going to have to use things like iron condors. You're going to have to go out there and you're going to have to learn a little bit, maybe about selling some premium and kind of minimizing that risk. You're going to have to figure out, hey, what's my delta? Or, all right, how do I sell an out of the money call spread on Amazon when it rallies 70 points in the morning? Think about that. It's going to be a trader's market moving forward. Could last years, okay? You really got to think about that. With that, we're going to get now down to some of the specifics. We're going to look at a few charts. We're going to look at some of the volatility. Let's get to it. All right, let's get to the charts. As promised, we were going to bring up a 5-year chart on Boeing, and we have done just that. And that's really where I want to kind of kick off, this portion of the segment. Let's actually talk a little bit about Boeing again on the 5-year. And the reason that I'm bringing this up again is to gain some perspective on some of the sell side activity that you've seen. As I was saying, Boeing's rise to greatness over here in just really 2 years time, Boeing is a $150 product that, again, the sell side activity that we saw in the last couple of days, it's just scraping the surface. And the reason that I bring up Boeing, you're going to sit there over the course of this weekend, over the course of the next couple of days, and you're going to think about some of the, your 401k, maybe your IRA, whatever your portfolio happens to be, whether you're long, whether you're short. You're going to think about overall risk, and you're probably going to think to yourself, is this going to be it? Should I possibly bail out of some positions? And to me, Boeing provides one of the best areas of perspective on that front. And again, I'm not displaying this in order, to create bears in the marketplace. I'm showing you this, to create the reality of a marketplace that is an overcooked chicken in a lot of cases. And again, that's a little bit opinionated in there, but just take a look. We haven't even scraped the surface of sell side activity inside of Boeing. And the reason, again, that I'm picking on Boeing, the reason I'm bringing Boeing up, Boeing is the largest component of the Dow. And the Dow is still trading again, and we'll bring up the Dow, and the Dow actually got whacked back a little bit, but the Dow is still trading at 25,000 in change, right? Again, some fairly wild moves in it, but Boeing, if it is to fall from grace, will absolutely decimate the percentage returns of the Dow. And that's the kind of perspective that you need to have, that, again, so what? We scraped the surface. I think a lot of people, they're going to look at a 9-month chart. You're like, yeah, okay, I can make an argument for more downside over here. And then you just bring up, again, a 5-year. And the reason I'm spending so much time in this is to give you that perspective, that this is, this $150 product that just explodes. Now, you can give me every fundamental argument that you want. When you're in the midst of volatility, do you think those computer systems stop and they go, but that PE ratio, oh, come on, let's get into a PEG ratio. And you just can't do that to yourself. You're looking at a $360 product. If it were to lose $100, how the impact to the Dow would be quite phenomenal. And that's some of the perspective that I really wanted to start with on that front, hence why I brought up Boeing. if you're kind of concerned about your portfolio, as I said in the moment ago, get your risk in check. Okay? You don't want to be caught on the wrong side of a marketplace. There are going to be phenomenal opportunities that are going to be presented to us. However, if you can't control what you currently have on, how do you think you're going to control risk and put more risk on moving forward? Next, let's bring up the SPX. All right, so the SPX, this one I'm going to go to a little bit of a tighter chart. Now, we've been talking about the SPX week in, week out, day in and day out here at TheoTrade, and we just went through effectively, okay, really one of the longest stretches of efficiency in a marketplace. So this entire stretch over here was efficiency. We only had 1, 2, 3 breaks of expected move. So what did we get? That's a 3 sigma break. Effectively what it means, we just ruptured to the downside. More importantly, again, that's hindsight, right? More importantly, what are we looking like moving forward? By the way, that little highlighted area, that's the rupture. What are we looking like moving forward? Okay, there's going to be a large expected move. How large? What are we expecting this next week? For that, why don't you go over to the SPX and actually pull up an options chain. In the option chain, now I am specific over here. I'm pulling up the October 19th, which includes the entire week. We do have an AM settlement and a PM settlement. I'm going off the PM settlement. It's a $71 move. Bottom line, $71 move being expected. We haven't seen a $71 move in a very, very long time, people, to get anywhere near that $71 move. Again, you got to come all the way back into the February timeframe, which, again, we had some fairly tumultuous volatility at that point in time. All right, so in the SPX, again, the expected move is large. However, this is starting to open up opportunities. That's why I'm bringing up the SPX. What are some of the opportunities? Sell some premium. That's the first time in a very long time I've mentioned that. And I've started to allocate some capital. Now, I'm actually into what we term duration iron condors. These are iron condors that are way out, 69 days out. Here's one 97 days out. And I'm starting to allocate capital. Now, as I start this, and again, doesn't matter how many contracts you got on, you have to come into this not heavy-handed. Like, just because there's sell-side activity a few days doesn't mean you step in, fire at will, sir. That ain't going to play. You got to distribute capital, okay? You have to have good allocation techniques, stick and move. Fire off some sell-side activity, let the market move. Fire off some sell-side activity, let the market move. Why? Distribution of capital into multiple expirations, okay? Distribution of capital over multiple strikes. Here's what I don't want you to do. If you're going to sell some premium, here's a deviation curve. I sell some out of the money crap here. I sell some out of the money junk here. If I do all my contract size right at these two locations, what do you think is going to happen? We're going to come right down to the edge of this, okay, and you're going to get smoked. What you want to do is layer in capital at multiple strikes, okay, over multiple what? Expirations. Maybe this is December, little bit of Jan, maybe sell a little bit of Nov, and we're having a party. Smooth the risk curve the best you possibly can. On rallies, look to buy back the premium you sold. On sell-offs, look to allocate more. Okay? That's what I mean by return of the trader. This is the kind of skill set you're going to have to get down. And then people look at me and they're like, I can't manage this many positions. What? If you go out there and you put on a ton of positions, imagine every one of these hash marks is a ton of positions. All you have to do is look at the delta. That stands for delta. Do not let any of this stuff intimidate you. If you're willing to spend, 2, maybe 3 hours, okay, in some of the TheoTrade archives, you'll know everything there ever was to know about delta. And you'll be able to manage your risk as an aggregate, not looking at individual positions. So that's the reason I brought up the SPX. Now, moving on, okay, in the SPX, great. Now we come to the XLF. The XLF, really, really key because the financials have been the linchpin in a big amount of this marketplace. And I've been stressing this week in and week out. Everybody's like, no, it's technology. Okay, I got it. Technology had a little sell-side activity. Technology got ugly, but it's the financials that rocked the S&Ps. Okay, we saw that very, very clearly on Wednesday. The tech market was already down. It was the financials. When they threw in the proverbial towel, the market sold off. 2650 is the line in the sand. The reason you got to worry a little bit about the financials, okay, big boy financials have earnings coming up. Earnings. Okay, if you take a look at stuff like Bank of America, it's on 10:15 before the bell. What? What is 10:15 before the bell? Oh, sorry, people. That's Monday morning. Welcome to a wild market on Monday morning. Remember what I said. If the market rallies, so be it. Maybe Bank of America is going to have spectacular numbers. So what if the market rallies? Okay, some of the premium I sold, I'll have the opportunity to buy it back. You think this volatility is going to dry up overnight? It's not. Okay, we're going to see some more sell side activity, be able to sell some more premium. Okay, when we bounce back up, buy back that premium. When we get whacked again, allocate. That's kind of the name of the game moving forward. Speaking of which, something like JP Morgan. JP Morgan's numbers, they weren't half bad. They missed on revenue, but they weren't half bad. It doesn't matter. Nobody cares when there's sell side activity, right? They will just beat up the marketplace. And again, JP Morgan's one of the larger positions we happen to have on right now. I've actually rolled almost all of my positions now into the December expiration. Again, deep in the money on JP Morgan. Okay, moving forward from the financials, which we know, again, and I want to reiterate this level. Okay, the level of, again, 2650 in the financials. It's the linchpin of the marketplace. If we're well under 2650, you know that market is going to get smoked. Okay. Speaking of levels, we're going to come to the S&P. We're leaving the best for last over here. The next I want to bring up happens to be XLY. XLY is the discretionary. It's consumer discretionary. The reason I'm bringing it up, I left on my risk twist spreads in here. Okay, I've got December risk twist spreads. They're partially in the money. This is again, a little bit of a long shot play that's starting to work. But if consumer discretionary continues its slide from grace, it's going to be a spectacular return from us. By the way, this thing was up almost 18% year to date and is now up 8%. So you're in pretty much corrective territory in a huge number of individual sectors. Okay, moving along over here. Let's get to the small caps. Now, on Friday, I actually traded the small caps for the bullish run, and we got it. We actually got a bullish bid back to the marketplace. But much more importantly, okay, let's not look short duration. The Russell is in the most serious trouble, okay, out there, period. The Russell right now on the year, after being up 13% on the year, is now down, officially down on the year. The troubling portion is the Russell, it didn't bounce. Now, I'm not saying the Russell's not going to bounce as you come into earlier in the week. As I just told you guys a couple moments ago, on a day-to-day basis, it's not about, are we going to go up or are we going to go down? There's no predictability. Not a MACD, not a Fibonacci, not a Bollinger Band in the world is going to tell you if we're going to go higher or lower. Okay, that has a lot to do with short covering, algos hitting the markets, some of the earnings coming out. They're all going to be drivers. Nevertheless, okay, the Russell is in very, very serious condition. And is this indicative of the interest rates? Absolutely. As long as interest rate fears are going to be there, as long as they're going to raise rates, you're going to get the Russell under a degree of pressure. At this point in time, okay, our strong belief is, hey, this thing is absolutely oversold. It will probably have some fairly wicked bounces. But the reason I'm bringing up the Russell, the volatility in here, it's pretty good. All right, this thing is rocking in terms of volatility, and it might produce some good premium selling opportunities inside of the Russell. Speaking of volatility, let's move right on to none other than the volatility index itself. The volatility index, I mentioned, kind of shoved it aside. It's at 21. Let's not all, start getting kinds of crazy in here. Listen, you put it up a 10-year. Obviously, there was a little thing called the financial crisis that happened back in 2008. In no way, shape, or form are what we're seeing right now, is that indicative of another financial crisis? Absolutely not. I'm not indicating that, okay? But I am indicating that we are going to be in store for some more volatility. But I just wanted you to get some perspective of where the VIX happens to be, right? We ain't home yet. And to think that we are, we haven't even hit what I would say tumultuous volatility. I mean, come on, you look back here in 2011, we're up in the 40s, but the VIX changed its equation a number of times, specifically in October of 2014. They changed the VIX equation to include weeklies in the SPX, and thereafter it made the VIX, I think, a much more efficient product. Not to mention that the market as a whole is that much more efficient, right? There's algos and so forth that are driving, okay? But here's one thing I want you to keep in mind. I do actually believe that the VIX can spike and can get insane because I think the algorithms, okay, the machines, they're going to turn on this marketplace. And all that buy-side activity and momentum, as soon as it shifts to the downside, we're going to find out the devious side of algorithms. Last but not least, on kind of this weekend update here, we're going to be talking about levels. I started with this a little earlier. Markets that hit patches of volatility become incredibly difficult, all right? Incredibly difficult day to day to discern, number one, where we're going, how we're doing it. So in that case, we use, levels. The levels that I have drawn on this chart are purely my own. These are what I term gravity points. They're concentric areas of risk of major trading firms. And I can't stress enough, if you want to, proofs in the pudding, I'm going to give you the gravity points. You draw them on your own chart. This is the S&P futures. And the gravity points have been there for months and months and months, of previous trade. So let's start with one of the absolute key areas in this particular circumstance. And I'm going to kind of draw them up sequentially and then display them. Okay. And again, very, very important. By the way, we're willing to, for those that are clients, of course, of TheoTrade, we will absolutely, share our charts. There's no reason that everybody from every walk of life, and again, I want to sometimes zoom into to give you a better feel for these gravity points. All right. First and foremost, up on the list, probably the most imperative right now happens to be none other than 27.31. Okay, so you would draw a price, across 27.31. Now, how do you draw a price on here? Well, if you're on thinkorswim, you can actually cruise over to the drawing tools. Okay, I don't do that. I just click that little mouse wheel and come right over here to price level. Okay, you can actually click like the wheel on your mouse, push down on it, and it actually brings up the drawing tools, a little shortcut. Anyway, 27.31. That's first and foremost on the list. All right, number two to the upside over here. That happens to be none other than, and I'm going to list it in here, 28.11. Okay, for what it's worth, I think we actually have room to be able to bounce right back into that 28.11. Now, if we start to, let's get crazy talk going. If we start to get above that, you're at 28.42. So let's go ahead and list that on the screen. So again, everybody has these 28.42. That would be, again, break back to the upside. Now, let's look at the more dire side of the marketplace. And again, I may have to kind of zoom out for just a second. There's 26.82 on your screen. So towards the bottom of the screen, and again, I put it in another color over here. That's 26.82. And then if things start to get really like wicked to the downside, and we're going to come all the way down, this happens to be 26.26. So again, 26.26. When I say that we're going to be pinging back and forth between levels, I can't stress this enough. What you're looking at right now is just a 1 hour chart. Here's this is now 180 days at 4 hours. And you can actually see us in the midst of volatility all the way back in February. It's precisely what we did. We're just pinging back and forth from level to level. And I cannot stress this enough. Mark the levels on your screen. We'll ping back and forth up to the upper levels. Again, we're already doing just that. When I say they're concentric areas of risk, now there's really detailed notes in the TheoTrade archives for some of these gravity points. I'll describe some of the gravity points throughout the course of this week live on TheoTrade. Again, keep your wits about you. Keep your head down, keep your risk under control. Do not fire big contract size right now, because one of the things you got to recognize, you're in a more volatile marketplace. You don't need big contract size, right? When you're in a 12 VIX and you shoot to like a 24 VIX, what's the first thing you do? Cut your contract size in half. That's the final thought I want to give you on this weekend video. Have a wonderful weekend, everybody.